Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Turning to the Federal Reserve, the list of candidates to replace Chairman Jay Powell reportedly down to the final five. The list emerging following extensive interviews with the Treasury Secretary Scott Bessent. On that list, Fed Governor Chris Waller, who joins us now. Governor Waller, good morning.
Well, good morning, John, and good morning, Anne-Marie.
Welcome back, sir. It's good to see you. How's the process going? Let's start there, and then we can get into all the other good stuff. How's the interview process going?
It's going well. As far as I can tell, the Secretary has a very systematic way of going down the list and doing the interviews. As I said the other week, I had a great interview with Secretary Bessent. Talked a lot about economics, Fed policy, the Fed, balance sheet, just general stuff in the economy and financial markets. It went very quick. It was about an hour and 45 minutes. The next thing I knew, it was over. So it was a great conversation. Of course, I love those kind of conversations. I can do that all day long.
The Treasury Secretary spoken about in the past, he wants almost a visionary, someone who looks forward, like an Alan Greenspan type, open-minded. Do you get a sense of what he means by that?
I think it's the idea of if you're looking at the data and it's always looking back at the data, the data is always kind of old and you have to think forward, like where are you going with this stuff? I've managed to do that a couple of times with thinking about this beverage curve argument back in May of 22 that we could have the soft landing earlier this summer with the weakness in the labor market, which turned out to be true. People doubted it at the time I said it, but so I think I don't want to, brag, but it's that kind of being able to look at the data and see forward where things are going, and I think that's a critical thing he's looking for.
You were certainly vindicated. The president was obviously excited about the fact the Fed finally was cutting interest rates. Have you spoken to him at all?
No, I have not.
Is that on the schedule?
I don't know. That's up to Secretary Bessent.
We're going to find out soon, hopefully. We'll talk to the man himself, the Treasury Secretary, hopefully later on in a month. I want to talk about the meeting that takes place at the end of this month as well. You were pretty clear going into the last meeting. You delivered a speech, and I believe the title was "Let's Get On With It."
Yep.
Are you advocating for the same thing at this meeting?
Yeah, I think it's the right thing to do. Back then, there was an issue of whether you go 50 or 25, and I argued we could do 25 and see how the data comes in. Of course, we're not getting much data. And then we can think about the next 25. So in the last 6 weeks, I don't think a lot has changed. We're not getting the public data, but all the private sector data that we're getting, Beige Book yesterday, everything we're getting is telling roughly the same story. The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now because you can't have a really strong growing economy and negative job growth or zero job growth. And, people talk about productivity, but AI hasn't had that effect yet on the labor market or productivity. It will down the road, I think, but not right away. So I don't think that's the story that's driving it. So in that case, one of these things has to move, right? Either GDP numbers start coming back down or the labor market rebounds. You just can't have growing economy and, very weak labor market. They just don't go together.
In the meantime, do you just continue to reduce interest rates meeting by meeting as you wait to see what's going on? What's your overall approach and how do you think about that?
That's exactly what I've been arguing is since we don't know which way this is going to break, if the labor market rebounds, there's less of pressure for cutting rates. If the growth comes back down, there's more pressure for cutting rates. You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do. But if you've already started the process, you're providing whatever initial support for the labor market that you feel is necessary.
So we've had this obvious step down in payrolls growth. It's pretty clear. Yeah. It feels like that alone, though, might be an outlier compared to everything else that's going on in the economy. You yourself just acknowledged that. What do you think is behind that? And can that persist?
That's the thing. When I've talked to private sector CEOs about hiring, we typically get a couple things. Maybe early part of the summer, there was a lot of uncertainty about tariffs. We're just holding off on doing anything. One of the things I heard is firms were going to have to pay the tariffs. One easy way to do that is just not hire. Take all the labor savings to pay off whatever the tariffs were. So that was one thing. then you have this AI story, which was people like, we don't know if we're going to need to hire, but we're going to wait and find out. We're not going to go out and hire a lot of people right away. So I think the tariff uncertainty, paying for tariffs, trying to sort out what AI really is going to do, has kind of put firms on their back foot. Now, that's what I mean. Either they decide the AI is not going to be in the near term the big job replacement that they thought, and they're going to have to start hiring, and it comes back, tariff uncertainty goes down. All of those things could lead to a rebound. On the other hand, if GDP starts softening, it's not as strong as we think, that somehow the data is a kind of a mirage right now. Then the labor market is telling you things are just not as good as you think. Now, the financial markets are the big puzzle. I mean, I'm not the only one. How much of this is just a big boom in AI and everything else is marginal? I've kind of been arguing there's a big difference between the financial conditions for corporate America and financial conditions for Main Street America. If you're Main Street America, you're looking at mortgages over 6%, very expensive housing, car loans over 7%, credit card interest rates in the 20s. These are not loose financial conditions for American households. So when we look at the financial markets, you're seeing a lot of when people talk about credit spreads and all that. I don't think most American households care what the credit spread between corporates and treasuries are. That doesn't really, unless it shows up in mortgages. So I think there's this is one of the things that I find kind of puzzling right now, is there's just always these dichotomies between things. If you look at AI, if you take out anything data center AI related, business fixed investment is turning down. It's not widespread. All this investment is not widespread across. There's a real reallocation from kind of everything else into AI. So there's this bifurcation in so many ways that make kind of reading the economy tough right now.
How much influence do you have on one versus the other? Financial conditions on Main Street versus Wall Street. Wall Street's immediate. Wall Street's gone. It's off to the races. Yeah. Can you really influence financial conditions on Main Street?
Well, that's kind of what we hope. If you think about cutting rates, which we're doing, and I think we'll continue doing, that does have a pass-through to the 10-year. And the 10-year is often the anchor for pricing mortgages. So the 10-year is down to like 4%. It's come down from 4.5%. That's about 0.5% off. If it were to continue drifting below 4%, you'll start seeing some downward pressure for certainly mortgages. Auto loans are kind of a different thing. They're trying to figure out how to deal with tariffs on the auto industry. One thing I've heard is they got rid of a lot of cheap financing that they used to subsidize for consumers. That's going to raise the cost of financing. All these things are more tightening for Main Street America. So hopefully these things, as we go on through the rest of the year, start loosening up some.
You've been watching the program, so you know some of the things that people say on the show. I'll just go over it briefly. Ultimately, equities at all-time highs. Gold's ripped 60% this year. You mentioned credit spreads.
Yep.
IG credit spreads at multi-decade tights. High-yield spreads near the tights of the year. And there's a theory out there that the Federal Reserve and some officials on the Fed, perhaps yourself included, have anchored their view of this economy around the step down in payrolls growth and are going to be lulled into reducing interest rates when maybe they shouldn't. And all that's going to do is fuel financial market excess. Just to give you the chance to respond to that, how would you respond to that? This idea that you run the risk of being lulled into reducing rates when maybe you shouldn't.
Well, the mandate I have from Congress is maximum employment and stable prices. It's not the financial markets. So that's why when I'm looking at the labor market. The labor market is weak. If all these loose financial conditions are going to cause a boom in excess in the U.S., we should start seeing some of that in the labor market. We're not seeing it. So a lot of this is, I think, this is where the AI thing is. There's so much speculation on AI that it's kind of, again, this dichotomy, it's kind of overshadowing everything else that's going on. And like I said, my job is unemployment and price stability. And I think inflation will be okay. It's on up, but some of the tariff effects will come back off. But my job is about the labor market, and it's not good. So if you want me to go to Congress and say, hey, tell me to start worrying about financial conditions, and that's how I should set policy, let me know. But until they do that, I'm going to keep focusing.
Well, let's go with the dual mandate, and let's stay with AI. And the potential that introduces some additional tension into the dual mandate, that it holds back employment, but also boosts prices. Anne-Marie was talking about what it could do to energy, all the spending, resource intensive. We had a guest on the program talking about the same thing. Would you see that as a potential that it introduces some additional risk into the dual mandate?
Well, in terms of inflation, I mean, one of the things, I was asked this question by some people in the AI sector. It was like, isn't this inflationary, all this spending we're doing? I said, yeah, but you're taking it away from other sectors. So those other sectors are seeing less demand. So this is, in my view, a lot of this is a sectoral reallocation. And if that's the case, then the increase in AI is going to be offset by other things. Now, true, energy may have a bump up, but then you just look at core, because you kind of knock out the energy part of it. And that's really what you want to do. That's why we kind of knock off energy. It's just so volatile, it gives you the wrong signals.
So, Governor,
when we look forward, when we're just looking forward.
What I hear from you is you can look through tariff-induced inflation, you can look at AI-induced inflation. Is there any inflation out there right now that you see that you are concerned about? Because we're potentially going to get a pretty hot CPI print at the end of this month.
Well, we'll see. When we take the data at the board and we have various ways we try to tease out the tariff effects, our estimate is inflation's running about 2.5%. And we're not seeing anything that's going to explode. Like I said, all this attention on AI is ignoring the fact that other stuff is softening. So demand is up in one sector, it's going down in another. Those things often, not completely, but often offset. So that's why I'm not really worried about the AI stuff. And if it really did cause some big problems in energy, like I said, just if you're thinking about future inflation, just look at core. Don't bother with headline.
At the end of the month, though, you might not get the labor market report.
Right.
How difficult is it? And can you even provide outlook, meeting by meeting, in this environment?
Well, I have this joke that for those who think we're too data dependent, you're going to find out what non-data dependent policy looks like.
I'm excited.
But that's the point. We do have lots of data. Like I said, we've got lots of labor market indicators that tell us the same story. It's not good. We don't get a lot of other things as, oh, the labor market's great. So I think the data from all the sources is telling you the same story. The labor market's weak. We're getting this data, conflicting data about GDP. Like I said, the Beige Book came out. It was not like everything's rosy and booming. There could be still, in the GDP numbers, still a lot of inventory pull forward that because the China tariffs weren't finalized, so get them in, get stuff in now. So it may be that we see, GDP start to pull off at the end of the year. I think about the tax bill in that there was a lot of incentives for business fixed investment. That's great, but that applies equally to AI and non-AI. So at the end of the day, you're still deciding whether you want to go into AI investment or non-AI investment, and the AI is winning. So I don't know how much of it, how big of a help it's going to be on the non-AI kind of sectors in the economy.
You've called yourself a techno-optimist. Enjoyed the speech, by the way, yesterday. Thank you for that. I just wanted to finish on this before you run. This feels different to last year. When you came out last year and you made a big step down in interest rates and cut by 100 basis points off the back of the employment scare through the summer, this feels slightly different in your approach. How would you describe the differences between now and the approach of you and what you're advocating for on the Federal Reserve to what the committee did last year?
Well, last year we didn't have all the tariff uncertainty. We didn't have this AI thing. Unemployment was not even remotely talked about. So I'd say those are the two big differences. Like I said, I think the tariff stuff will settle out and it'll be okay. The AI thing is the concern I have with the AI, if it does, and I think it will materialize. Monetary policy is designed to deal with cyclical movements in the labor market, kind of ups and downs that come with a business cycle. But this feels like a structural change. All right, labor demand just drops and doesn't come back. That's something I can't do anything about. The Fed can't kind of adjust policy to deal with structural changes in the economy. So it's going to be a challenge to say, is anything we're seeing in the labor market from AI coming down the road, is that something the Fed can do anything about or should do anything about? Or are we just seeing kind of a typical cyclical movement where there's a hot sector and then it cools off later and everything's not quite as futuristic as you think it is? So that's, I think, for me, the biggest challenge looking forward is this a structural change or is this just a cyclical change?
Is the prudent thing to do as a risk manager just to assume it might be cyclical and cut just in case?
Yeah, I mean, if you cut and it ends up being structural, you cut. It's not going to undo whatever you did. But if it is cyclical, then you can help rebound and get the economy back on its feet, or the labor market back on its feet.
Stay with us. More Bloomberg surveillance coming up after this.
Emery was talking about China and the U.S., and there's no one better to talk to than Michael Roberts, CEO of HSBC, a bank, and CEO of the Corporate and Institutional Bank at the region. I'm just curious, given the fact that HSBC, and welcome, is such a central bank in both trade as well as in both China and in the West,
right,
how significant do you see this latest eruption of trade tensions between the U.S. and China? Does this feel different?
Yeah, no, first of all, thank you for having me today. Look, I think the world has got gotten used to a lot of these tariff changes, although certainly this newest round is yet another bit of unpredictability. I think companies have been now looking for different ways to manage their supply chains. We have a survey that we did right after Liberation Day, which I think still holds true today. We surveyed 5,000 clients, so big survey, and they all said, one, all of these tariffs are going to cause a lot of issues. Prices will go up. Two, most of them now are looking at their supply chains. And the word, I think, supply chain has now come to be one of probably the most discussed terms in any C-suite today. And thirdly, they're going to change, and they may even change business models. So this next round, this current round, I think just tells you that they're going to have to significantly change what that is, because 100% tariffs, you can't absorb 100% tariffs. So that means there'll be a greater acceleration to where those new supply chains will be. However, it has been a bit of a whack-a-mole because you have to constantly look at where the next tariffs will come from. And that's been a challenge for many companies. They really have to figure out what is the least vulnerable place they can be or the most tariff-proof place they can be, and how do they then export into the U.S. or frankly anywhere to make sure that they can do so as effectively as possible.
How much of the extra costs from tariffs been realized? And not just tariffs, but also the rejiggering of supply chains.
Yeah, so rule of thumb, when I've talked to most people, probably 70-80% is borne by the producer versus the importer. The last 20% now is starting to seep into end buyer, the customer. I think most are saying we can't continue to absorb that much additional cost as the importer or the distributor. Therefore, it will start shifting more and more to the end buyer, the client or the customer. So that there's been I think a strong effort, however, to try to absorb as much as possible. So I talked to a retailer, a high fashion retailer, saying me and the distributor or the producer out of Asia and me as the distributor are absorbing as much as we possibly can. We understand we could do that, but it will come to an end soon.
John and Anne-Marie were talking to Fed Governor Chris Waller and about the balance between inflation and the labor market. And there's this feeling that any kind of inflation is going to be short-lived and the effect on the labor market could potentially be pernicious. Are you seeing that companies, instead of raising prices, laying off workers or trying to revert to artificial intelligence to bridge the gaps?
Not yet. However, there is a lot of cost pressures. I think there's a delay, a lot of investment. I mean, that's the flip side of that, because I do think people want predictability. The companies need to understand where they're going to put down a lot of capital, that capital is going to produce good returns because more predictability. I've seen slowing of hiring, but not real firing today. And so that's kind of, again, the flip side of that coin. But really, it's the capital and the investments that you're starting to see slow down quite a lot.
Meanwhile, we've heard a lot here at the meetings in Washington, D.C. about a number of themes, AI, which we'll get to in a second, but also this question around credit froth and an AI-related bubble. How much are you getting concerned, akin to what J.P. Morgan's been talking about, of a real turn in the credit cycle or some sort of later innings that give you pause and make you more cautious?
Yeah, look, I do think this is not the first instance of what is inventory financing fraud, which is essentially selling, or using the same bit of inventory to finance multiple times. We've seen that in Europe a couple times as well in the last, say, 9 months. So I am more concerned, and something that we're very focused on. So, in fact, we're using technology we developed in our trade business and using it throughout all of our lending platforms now to try to go through and be very specific that everything we finance is good collateral. It doesn't have multiple liens on top of it, which is really what happened at First Brands. It's tough to do, and I think, the fraudsters are getting better at it. So we're going to have to respond to being much better on due diligence. We were not involved, obviously, directly in First Brands, so don't know how much due diligence was done, but I think these type of financing arrangements are going to require much more due diligence, much greater technology, much more specific understanding of exactly what you're financing.
The other aspect has been just sort of how much AI has actually boosted productivity, boosted profitability versus been a real cost center for the most part. Ken Griffin came out of Citadel saying that he's not seeing evidence that AI programs can really make an edge in financial markets. I know that HSBC has been big in quantum computing and has this test. Are you seeing real gains? Are you actually deploying quantitative strategies from quantitative computing on your trading floors?
Yeah, so just for those who don't know, we had a partnership, still do, with IBM. We developed quantum computing really for financial markets, focusing on the bond market. And we use both quantum computing and more traditional computing, brought them together, changed the way we looked at data. There's this thing called representation data that we actually flipped into a more of a quantum computing type of mode. That led to a 34% improvement in our ability to predict a trade. So if you were going to make a trade, we get to understand that trade 34% better to see the matching between buyer and seller is really what it comes down to. So that was very effective. It's an initial study. We did, however, test it on multiple quantum computing machines. We did all the statistical analysis. So we really do think there's something there. It can be used for any traded asset, so any asset class. I think the power that brings is going to give an edge. I don't know how it wouldn't give an edge, but I think it'll be, once we roll it out and others roll it out, there'll be quick adoption by, I think, the industry. I mean, it's the same industry that tries to reduce latency to its, smallest possible amount. So I do think technology does bring a substantial edge.
Do you think it's going to replace traders?
That I don't know. I mean, I think there'll always be humans involved, but I think it'll help traders quite a lot. And I think it'll change really the way traders think about it, because when you have that much compute power and you could really use it, I think today, we use a lot AI, as you said, through algorithmic trading. This will just be one more substantial boost to the power of algorithmic trading that we see today. So will there be less traders? Don't know, but are they going to have powerful machines? Definitely so.
The other theme here, and this is something that comes up in pretty much every conversation, is the debasement of the dollar. Yeah. And this question of how much the dollar is losing its heft as a reserve currency. Yeah. Internationally, do you see any signs that people truly are moving away from the greenback? Yeah, it's a great question. So I happen to be traveling to Asia right after Liberation Day, and I would say that was probably the number one conversation that I was having by very big, very sophisticated, large holders of dollars. And they were quite focused on this idea of de-dollarization or debasement of the dollar as a reserve currency. And the mere fact that they're talking about it in the terms they were tells you something is different. Now, if you look at where the dollar is today, trade flows, reserves, the primary currency of invoicing for most commercial flows, the markets flows, it's all well north of 50%. It's 60, 70, 80% in all those various metrics. It will take a long time to find another reserve currency. And the other biggest question is, if you're going to go away from dollars, what are you going to do, and what will be that reserve currency that replaces it? There is no other alternative today. And so that's the twin issues that you have, the conundrum. Maybe go away from dollars, but what are we going to go to instead? To wrap it all up, there is this feeling that the center of finance has shifted. Mm-hmm. And it's not so clearly in the United States. And it's something that you've been focusing a lot. How do you see the sort of tentacles of finance in terms of where they are flowing from, transforming really over the past couple of years? Yeah, no, I think there's significant transformation going on. And if you think there was a unipolar world with the U.S. right in the middle of it, still is, and the U.S. capital market is the most liquid of the world, still the dominant place to trade. However, you need to look at where trade and commercial flows are going, where financial flows are going. I would look between the Middle East and Asia as an example. Substantial increase of flows between those two regions, and they're not flows that are necessarily coming from the West, just being transshipped through those regions. They're actually wealth that is being rechanneled in that region itself. I think you'll see that more and more. I think you'll see Asia, Middle East coming together more and more, and I think you'll have a much more balanced equation. I don't think there'll be as a dominant, source of financial flows that you've seen before. And great for us because we have to be very strong in those two regions. But I do think people need to understand that there's a significant change going on, and those flows will not just go through New York as they used to in the past.
Stay with us. More Bloomberg surveillance coming up after this.
I would love to welcome in Scott Kirby, the CEO of United Airlines. And Scott, it's really tremendous to see not only what you did, but also the fact that you see significant upside to the fourth quarter. And I want to just start there. Where do you see the acceleration in demand?
You look across the full year, the first 3 quarters were really good for United in a lot of macro volatility that happened for the aviation industry. That demonstrates the resilience of our revenue diverse, brand loyal business model. But you look to the fourth quarter, it's even more exciting because as the economy is starting to get back to a solid footing, at least for aviation, demonstrates a lot of upside. We think we're going to be able to grow earnings for the full year, even in this environment. So it really is creating value for all of our customers, all the way from basic economy to winning much higher market share in the brand loyal customers. Really is a great resilient strategy when times are difficult, but a lot of upside as the economy recovers here in 4Q.
I guess I want to drill into the economy because, Scott, earlier in the year, it had been the economy section that had struggled the most. I'm just wondering how much it's picking up, whether you've had to discount tickets to bring people in to compete or whether consumers are willing to absorb higher prices and just and take their trips.
Yeah. Well, as we've talked about before, Lisa, the airline industries are a pretty good real-time indicator of the economy. And, we saw for much of the first half of the year economic stress and ticket prices were lower as a result of that. But as we got into the third quarter, bookings, at least for future travel, the economy started to pick up, bookings started to pick up. And as we finished the quarter, we've set records each of the last several weeks on most corporate revenue that we've ever booked in a single week, and a number of records, particularly in business travel. Really kind of strong across the board, though. Internationals come back stronger. The period has extended. Premium is obviously stronger than main cabin. But really, we've seen improvement, as we've moved through the third quarter, kind of across the board on revenue streams, with the biggest strength in the corporate segment.
And that's actually something that we see across the board, particularly because there are all these deals. So people have to actually get on a plane and go see some of their clients.
We love that.
I am wondering, are you seeing international travelers, tourists come back to the United States? I know that was kind of a soft spot and a sort of a tell in terms of the international reputation of the country.
Well, our business is about 80% U.S. point of sale. But we saw a drop in international traffic earlier in the year. It's not quite back to last year's levels, but it has recovered and it's close to last year's level. So we did see a dip, but even that has come back, and we think that's on the trend to getting back to normal pretty soon.
Are you planning to keep capacity pretty much the same? Are you planning to expand or cut back? I know that it was constrained earlier this year just because of demand, but as demand picks up, are you going to bring more planes on deck?
Well, we've been growing, in absolute growth, actually faster, I think, than any airline in the world has ever grown for several years in a row. And that's worked really well for United, and that's been successful. So we really haven't much changed our capacity. We tweak it here and there. The biggest change we're going to make for next year, I think, is actually to reshape the seasonality of the year. One of the things that's happened that's good for our business is this third quarter peak has extended into the fourth quarter. And it's made the fourth quarter actually a better quarter from a margin perspective than the third quarter. And what we think is as that, particularly that international demand has extended into the fourth quarter, there's an opportunity for us to actually fly less in the peak in the third quarter, which will be good for our RASM. But it turns out it's going to actually be good for our cost structure too, because we have to build staffing and infrastructure, everything up to that peak for 6 weeks of the peak summer. And so next year we're going to actually try to reshape our schedule some to lower the peak and let the demand spread across more of the year.
I know earlier this year when we were talking, you said that you do expect to raise prices by, single digits just to compensate for higher costs. Do you see that on track, the same type of price increases, and are consumers okay with it? Are they absorbing it?
This year prices have come down, as we talked about, as there was macro volatility, at least for aviation. I do expect them to normalize next year, and I think just over time that you should expect to see airfares grow consistent with inflation is likely what's going to happen over time.
How much do you see staff wage increases also playing into this? The idea that a lot of the people who work for United are also saying, okay, well, things are going up. We want a pay increase.
Yeah. Well, our people are the best in the world, and they deserve industry-leading contracts. Every time we sign a new contract with one of our union groups, they expect and deserve and will be, paid at the top of the industry. So that's built into our forecast. That's built into everything that we're doing. One of the great things that we're doing, though, at United is I think we're the best in the world at managing our real core costs and being more efficient at the airline. We've invested heavily in technology to helps us run the airline better. But like you look at the third quarter, there are a number of airlines that have talked about missing their cost guidance because of storms, and there were storms in the quarter. But we've invested so heavily in our recovery tools that we had best in the industry cost performance, and we're driving our costs lower not by taking things away from the customer, but by actually investing in technology that lets us run a better operation for customers and is lower cost at the same time. And that also helps fund investments for the customer. We're spending over $1 billion a year in incremental investments for the customer, but also importantly, investments in our people and having them have the best pay and the best contracts in the world.
Scott, I love saying that you're my favorite economist to speak to because you do have this real-time view of the economy. And right now, what you're saying is kind of flying in the face of the weakness and some of the worries that we're hearing, whether it's from the government shutdown that's going to cause disruptions or whether it's the employment picture that people are increasingly worried about. How do you square those two things, this reacceleration that you're talking about, with the weakness that policymakers seem to be so worried about? Well, uncertainty really is, I think, what drives the economy in one direction or another. And there was a lot of uncertainty to start the year. As we kind of got into the third quarter and some of the macro issues, the reconciliation bill passed and geopolitical situation improved, tariffs settled into having some confidence what they were going to be, we saw that improve. Now, we do now have, new issues, that things pop up all the time. What's happening with the shutdown could become an issue. So far, it hasn't been. First, the FAA is doing, I think, a great job of running the system. We have our lowest cancellation rate in the last decade, our second best on-time performance. The controllers are professionals. There's not news about it, but the controllers are professionals, view their job as safety, view their job as taking care of the public, and kudos to them. Almost all of them are showing up to work and doing their job. And the first couple of weeks of October hasn't really affected bookings. I think if this goes on for too long, certainly the risks escalate in the economy as it goes on. I think the economy is better than most people think, but it's still tenuous. It's still a little balanced on a knife edge, and we shouldn't have unforced errors. So let's get the shutdown settled.
Stay with us. More Bloomberg surveillance coming up after this. Today, the DOE announcing a $1.6 billion loan to a subsidiary of American Electric Power. The goal is to strengthen grid reliability and, of course, lower energy costs across the Midwest. The U.S. Energy Secretary, Chris Wright, joins us now for more. Mr. Wright, Mr. Secretary, welcome back to the program, sir. Let's just start with giving you some time to explain what brought us to this moment and what the broader strategy is.
Yeah, the broader strategy is to use funds to better the American experience, lower costs of ratepayers, lower taxpayer expenditures. I mean, in short, President Trump got elected to get rid of the nonsense. We're not about climate politics now. We're about energy for the American people. How can we lower their cost of energy? How can we enable AI and manufacturing to reshore in our country? And this program, this loan is a perfect example of that. This is to reconductor 5,000 miles of transmission lines. Existing right-of-ways, existing towers, just put better conductors up so you can get more juice through the same corridors you already had. This is the kind of things that helps American people and American businesses.
Secretary Wright, your department is saying that and projecting that data centers, commercial customers are for the first time ever going to use more electricity next year than households. Is the federal government going to have to step in and help American people, consumers, foot the bill?
Well, the American government's doing everything we can to enable the growth of electricity production in this country. The last administration was about energy subtraction, trying to get rid of things they didn't like and subsidize things that are unreliable, that use a lot of land and drive up electricity prices. So, yeah, we're trying to reverse a tidal wave. That's a challenge, but we're going to do it. And ultimately, AI is not going to make electricity more scarce and more expensive in the country. It's going to make electricity more abundant, more reliable, and ultimately more affordable. So we can walk and chew gum at the same time. It's a challenge, but we're going to get it done.
Well, the administration, though, has purged some clean energy projects. Do you want a whole of energy approach or just specific types?
We care about affordable, reliable, and secure energy. Yeah, I get asked all the time, aren't you all of the above? No, I'm not all of the above, and I've never claimed to be. If you put, it's not just more electrons on the grid. To collect more wind power in the middle of the night in Iowa, that doesn't increase the capacity of our grid. That doesn't drive down anyone's prices. It doesn't allow us to reshore manufacturing or data centers here. The electricity grid's very different than your gas tank. What matters is having reliable power to meet peak demand times. If you're not there at peak demand time, you don't add any value to the grid, you just add expense.
Well, when it comes to reliability, right now, the U.S. government is shut down. Are you speaking directly with senators about when the U.S. government could reopen? How is it affecting your department specifically?
Oh, that is a great question. And yes, I am speaking to U.S. senators on both sides of the aisle. The shutdown is definitely destructive. Everything we're trying to do is lower American energy costs and enable American businesses to build more manufacturing facilities in our country. Losing workers, having uncertainty, having funds frozen or uncertain, that's not helpful. If I can give one example. We are modernizing our nuclear weapons stockpile at the Department of Energy. That's done by about 100,000 contractors. They're not government employees. They're contractors. So they're not going to get back pay. We've been paying them to date. But starting tomorrow, Monday at the latest, we're not going to be able to pay those workers. If that continues on for long, they may get other jobs. They're going to stop their efforts to modernize our nuclear weapons to guarantee the sovereignty of our country.
Secretary
That's not
Wright?
something we should mess around with.
Are you saying you are furloughing employees at the National Nuclear Security Administration, which keeps our nuclear stockpile in check?
We have not furloughed anyone yet, but we will be out of funds by tomorrow or early next week. So we will be forced to do that if this shutdown continues. I desperately do not want to do that, but I have to follow the law.
Well, what does this mean for our national security posture?
Of course, we keep people for emergency services. Our existing nuclear stockpile will be secure and will be ready. But the modernization program to replace our older weapons with new modern weapons, that's a key part of my job. We're just ramping those efforts up. We're just getting momentum there. To have everybody unpaid and not coming to work, that will not be helpful. I'm adamantly in favor of ending this shutdown as soon as we can. Unfortunately, Chuck Schumer's worried more about AOC than America's nuclear safety. That's just deeply un-American. I'm very disappointed with the Democrats. We have a clean CR to just continue the Biden-level spending we had before. It's got bipartisan votes in the House and the Senate multiple times. It's just a small number of Democrats that are standing out thinking they're going to win new subsidies by holding our modernization of our nuclear stockpile hostage. This is deeply irresponsible.
We also have at this moment a current trade war between the United States and China with a lot of hot rhetoric the past few weeks. What is the department doing in terms of sourcing rare earth minerals that come from China? And China right now is trying to really put a chokehold on them.
Yes, that is another critical effort at our department and across the Trump administration. We have made ourselves far too dependent on, as you say, critical minerals and products that come from them, that come from China. We have an across our department and across the administration effort to reshore the mining, the processing, the manufacturing for these critical projects in our country or in our friends, neighboring countries or close allies of ours. This is an absolute critical effort of the Trump administration, but it's going to take time. It's years that dug us in this hole. It's going to take us many months, hopefully not many years, to get out of it. We will achieve it during the Trump administration, but you're right, we're vulnerable today, and that's at a loss to Americans. 4 years of unserious government focused on climate change and energy subtraction, outsourcing anything that consumed energy out of our country, that was deeply destructive. It angered Americans and it elected President Trump. We need to fix it.
You come from the private sector. Are you comfortable with the president taking equity stakes in some of these companies that he deems critical for the U.S. national security?
I am, and let me tell you why. China has used market forces to push us out of all these critical industries. As soon as we invest money, or American businesses invest money, to mine samarium or process that in the United States, they flood the market, drive the prices down, and people can't raise equity capital. They can't develop those resources. China has used manipulation of markets to keep us and the rest of the world out of these critical materials. We need to do things differently to make it so it does work for American businesses to do these things in our country. That means the government providing loans, the government's providing equity capital, the government's providing other out-of-normal market mechanisms to make it happen.
Are you not concerned of distorting the market, though? You're a capitalist. Is this not distortion? It feels like the U.S. government is doing what China does, which is picking winners and losers.
Yeah, we don't want to do this broadly in our economy, but China has effectively distorted the market to push everyone out of these critical industries. The only way for us to get back into those industries is to respond to China's market distortion, and it does require things out of the normal market mechanism. But that's in a narrow area of these critical minerals and materials, but they matter for our national security, and they matter for our economic security.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.